Let's have a look at the market. So first off, read this disclaimer carefully. So what I find especially interesting today is the natural gas futures. Trading the natural gas futures is, for the more advanced traders, but you do have some ETFs. You have Boyle, which gives you 2 times bullish leverage on natural gas. The current price for Boyle, the ETF, is $17.78, and it's going to go down now to $15.15. In the pre-market now, it's about to go live, so it's cheap. So this is basically a bit of a gambling position for me. I would categorize this as one of those good alternatives to playing the lottery. So my thesis is bullish on natural gas. Yeah, we have seen a very substantial pullback so far. These are the weekly data points. If we look here at RSI, we are very low, historically very low, but we aren't at screaming low prices. But I think this is just worth a bit of a bet. Looking at the MACD, we are extremely low. There have been times back in 2009, the global financial crisis, where we were lower, but this is just abnormally bearish. Looking at the purple 20-week PPO, the green 50-week PPO, this is really some low numbers. So we are definitively oversold. Here are the daily data points. Similar message, you just seriously oversold. Looking at the daily RSI, this is very viable level. Multiple times where we tested it, it resulted in a bounce. Here it was rather messy. If we go back here, it was a bit of a surgical buying opportunity. This is just, it's worth the risk. But I would say, yes, this is risk. If you use, because the natural gas in and of itself, just trading the commodity, it is ridiculously volatile. You just look here at the percentages, like to get an accurate measurement, like here, approximately. Just going up here is 28%, going down here all of a sudden 20%. So big numbers happen quickly. And if you are going to trade the Boyle ETF to get bullish exposure, and it gives you 2 times leverage, the percentage moves are really big. So yeah, using a stop loss with these kinds of wild moves, it's challenging because we put your stop loss. So in this situation, I actually will buy Boyle, position in Boyle, but I will not have a stop loss. It will be just a bit of a gambling position with the assumption that sometime in the future, I think it's a decent probability that I will be able to exit with a profit. These leveraged ETFs are not intended for longer term holding. They are not. They can degrade over time. That also is one of those factors that add to the gambling situation here. But this is just too interesting. We have a very abnormally bearish situation now for natural gas. You could make a pretty bullish case for it. So let's look a bit at the seasonality. So to the left here, with this seasonality tool, it tells us that it can actually go down substantially more. So here are my notes. I will give the bulls a 5 here on the technicals. So here is the seasonality for natural gas. So we see here to the left over the last 10 years in red, 5 years in green, 7 years in blue. It's pretty bearish into the end of January. The caveat is that if you look here at the seasonality to the right, January on average is a bearish month, but we already are at a 10% loss, which is in line with a lot of the bearish months. There have been times where we have gone even lower, but after the market opens now, we are going to have a pretty decent bad seasonality reflected in the Boyle ETF as well. The issue is that, yeah, looking at the seasonality, it can go lower. Also, you can see here that February is not really a bullish month either. But when you look at December, we had a 36% loss in 2022, which is way outside of the norm here. So we've been very bearish. We just have. But looking purely at the facts here, it's pretty clear the seasonality is pretty bearish. I will give the bears a 7 here on the seasonality. It's not good. On the fundamentals, however, I do think I will give the bulls a 6. I can't show the tool I use for fundamental analysis of commodities because it's not intended to be shared due to like license rules. But natural gas is very low. It's a bit of a tricky business to really get a number for commodities because, especially now with all of these geopolitical factors, it's pretty complicated and there's many unknowns. But natural gas is at a low level, especially given the context. I'm having some technical issues here with the correlations. I am not getting them calculated here. So that's a bit of an issue. I would use, of course, different things to compare it against, but we can look at natural gas against some of the obvious alternatives. Well, not alternatives, but obvious things to compare it against. Let's look at crude oil futures, like that. I'll click enter. So this is relative performance. In this relationship, natural gas has underperformed substantially. Also seems to be some kind of time cycles here, so how reliable are they? There's some reliability, but not squeaky clean. Yeah. It's if you look here also at the RSI, we are at a relatively low level in this pair that usually results in a reversal in favor of natural gas beginning to outperform crude oil a bit. Let's look here at the seasonality. Usually here quite bullish for natural gas. That's nice to see. Looking here at the performance of January, there's been numerous green months as of late, but the red months have been very red. So it's a bit messy, but sometimes the market will give you a messy setup. Next, let's quickly here. So now the market is opening. Let's look here at natural gas. Let's look at the 5 minutes mark. Natural gas is still actually going down. It's in a downtrend for sure. Yeah, I just went ahead and opened a position in Boyle. I don't have a stop loss on this one. It's just these moves are too wild. It's very difficult to have a stop loss. If you are going to have a stop loss, with these kinds of products, maybe you could have like a 40% stop loss, something like that. But it's a very wide stop, and in an overall portfolio, it is okay to have some just wild bets. This is a wild bet. But if this was another product, I would definitively consider having some kind of stop loss for sure, because then it would make sense. But let's continue with the analysis here. But I already did open a position on Boyle. It's not a large position at all. Let's compare natural gas against uranium. Uranium is definitively in the news. I do think that uranium will solve a lot of our energy problems, but there are geopolitical reasons why uranium has been oppressed. But I do think that uranium will have a comeback, but it's going to be a very difficult road for uranium. Yeah, okay. Okay, anyway, you can see here that looking at RSI, we are at a pretty low level in this pair as well. At these low levels, there's a tendency for natural gas to begin to outperform uranium. If we look here at the seasonality for the pair, yeah, January is not especially well. Ever since 2014, however, overall, natural gas has a bit of a tendency to outperform uranium. The quote-unquote nice thing about this year is that so far we are at a 10% underperformance here for natural gas, which is which is on the higher end of the underperformance spectrum. But of course, the worst times we have like minus 43% or minus 39%. But yeah, when it comes to relative performance, I will give the Bulls a bit of a 3 here, a bit of a modest score. But yeah, we end up with a 1.8 in favor of the Bulls. We are very oversold, but to be perfectly clear, this is definitively a gamble. It just is. The split second you hit buy on an ETF like Boyle. Same thing if you actually get into like the gold miner and leveraged ETFs. The moves are very big. They just are very big indeed. So it's going to be tricky to put in a stop. But natural gas is definitively especially wild. At least in the gold miners, you can have technical like um, trends that are a bit clean. But as you saw with the natural gas futures chart, it is so erratic. The moves are just so violent. All of a sudden, the commodity is down like 10%, and then your leveraged ETF is down like 20%. And if you have two of those days, I mean, but yeah, in this case, I don't think I will have a stop loss. If I were to have a stop loss, maybe minus 40%, but then I would have to more like put in an alert and then review the chart when that is triggered. But when it comes to these kinds of situations where you have like a security that's been very bearish, like natural gas now, and it's starting to, it was absurdly bullish, like very overbought. Now it is absurdly oversold. Those kinds of emotional, volatile situations in the market, those are the situations where when you put on a position, and let's say that this one doesn't work out, it's very important to just to not scale into the position. Because that is very dangerous. That's how you can really compound your losses, which is obviously a very bad idea. So if this position doesn't go against me, of course it's good, but if it goes against me, so I have now put to work 50% of what I would be willing to gamble specifically on this position. So if it were to go lower, I would be able to add that 50% such that my total 100% intended position is in place. But nothing more than that. It's very important to have that ceiling, to have that cap. So if I'm wrong, I can only be that wrong. If you then look at the chart, and you have, let's say you have a big loss on both, and then you say, well, this is an even better opportunity. It's just too dangerous. That's how you really can just get wiped out. Thing is that there could be something unknown to anyone outside intelligence agencies, basically, that is a reason why natural gas is going to go much, much lower. Obviously, we don't know that, but if there are these X factors in the special in a geopolitical situation like this, there could be many X factors out there. If you don't know those X factors, they can really be bad for you. Not a good idea, obviously. So yeah. So that's the thing. Now I think that these kind of gambling positions in the market. I mean, there is a rationale here. I did do an analysis, but those sort of positions where you don't really feel um, like you really, yeah, you have this kind of setup, then I wouldn't have more than like 5% of the overall portfolio in those kinds of gambling ish trades. And I would view this as a complete replacement of any other type of bets, like, lottery and stuff like that. So I would just say, just don't get into the lottery. Just don't just play slot machines or anything like that, because in those situations, the odds are truly atrocious. I mean, they are so stacked against you. It doesn't make any sense. At least when I hit buy on Boyle now, I could make a pretty decent gain. And there's a rationale, there's a bit of a logic, there's some analysis in play. It's not like with a slot machine where the math is inherently just stacked against you. Whatever you do as far as timing doesn't actually really matter. Other types of like alternatives to gambling that I would say are in the stock market. That is when you buy calls or puts on a position, because in the options market, when you just buy a call or a put, you can make very big gains, but statistically, most of those options, they do expire worthless. Obviously, you can of course exit the option before that, but option in the option market, right? There's also a situation where the moves are very big. So if you buy a call and it doesn't go in your favor, then all of a sudden you are at like a 30% loss. So like that's more of a bit of a gamble, and a very good alternative, I think, to actual gambling, which makes no sense logically.